Imagine how you would feel if after decades of working, sacrificing, and saving, you were able to take all of the money you saved up, turn it into retirement income, and never pay taxes on that money again. Now, I know to some that what I'm proposing might seem just a little far-fetched, but in this video, we're going to explore how a person can maneuver matters so that they pay no taxes in retirement. My name is Jason Kennedy. I'm the founder of the Kennedy Financial Group, as well as the founder for the Chicago Alliance for Medical Professionals and Educators. For the last decade, we've been working with educators and medical professionals to help increase their retirement income by helping them add tax-free assets to their retirement plan. If you haven't already done so, we encourage you to subscribe. That way you never miss any of the content that we're producing on a weekly basis. Now, going back to that idea of creating tax-free retirement income, it's beneficial for us to just briefly remind ourselves, why would a person want to have their income in a tax-free position? The first reason is obvious. A study recently published by Forbes revealed that the average person pays more than $500,000 in taxes in their lifetime. So a person may desire that when they finally get to retirement, they may desire to have themselves in a position where they've organized themselves to not pay taxes on any of their retirement income. And this is not tax evasion. These are the rules that the IRS allows a person to operate within. The second reason why a person might want to structure their retirement to not pay taxes is they might be worried about potential tax increases. You see, it's important for us to remember that whatever amount or tax rate we're currently in, it's not guaranteed. It can change. In fact, if we look at this historical chart, we can see that when you compare tax rates now to where they were in the past, tax rates have actually gone down, so much so that they're lower than at any point in time they've ever been in history. When you couple that with the fact that the government is in debt and they need more money, many are concerned that tax rates are going to go up. And individuals who realize that, they want to structure their assets in a way where they don't have to pay a large portion of their money, their savings, to the government in taxes. Some additional reasons why a person might not want to have their retirement income taxed is they realize that their taxable income determines whether they'll have a surcharge on their Medicare, and they may want to avoid that. They may also be aware that based on how much taxable income they have, they could also unwittingly cause their Social Security to be taxed anywhere between 50 to 85%. And then finally, if a person has an emergency in retirement and they need to access a larger portion of their savings, that emergency withdrawal could increase their income, push them in a higher tax bracket, and cause all of their funds to be taxed at a higher rate. And so all of those reasons just highlighted are the motivation behind many savers right now trying to strategize to maneuver matters to be in a lower tax rate or in a totally tax-free position in retirement. But getting to this point, to this position, does not happen by accident. It requires proactive planning. Now, I'm going to share my screen because there's a common mistake that comes into play when a person is planning for retirement. Oftentimes, individuals will plan for retirement by just saving money in their 401k or their 403b, or relying on their pension. They may rely on these things unaware of the fact that all of those funds, when they get to retirement, are taxable. They count toward the calculation for income. That means that when you get to retirement and you pull money out of these accounts, you still have to pay taxes on these funds. Social Security is also included in this calculation, but the government only includes half of Social Security. They only include half of it, right? So if a person has money coming from the 401k, the 403b, maybe a small pension, and half of their Social Security, depending on how much that adds up to, that's going to determine the tax rate they pay in retirement. Now, the problem with having all of your money connected to these assets is you have no control. Whatever amount of income you need to live, you're going to be forced to pay taxes on it. Just as a simple example, imagine for a moment that you got to retirement and through all of your assets, various ones mentioned here, you wanted to create $90,000 worth of income. Well, if that was your goal, you would be forced to pay taxes on that 90,000 because it's all coming from tax deferred assets. So if you do the math, you could end up paying $14,000 a year. We're assuming a 18% effective tax rate. That's including federal and state. State here in Illinois is about 5%. You pay $14,000 a year. Over 20 years, that would be $284,000. Over 30 years, that would be $426,000. And over 35 years, that would be $497,000. So that's a lot of money to give away to taxes. And that's not even all of it. Depending on the amount of money you need in a given year, Social Security could be taxed. Your Medicare could be taxed. If you need to take more than this $90,000 out because of an emergency, that could push you up, and then that money could also be taxed. But on the other hand, let's say you were a little bit more strategic with your plan. Let's just erase this. And instead of having all of your eggs in one basket, so to speak, let's just say you had two. Let's say you had one where you had tax deferred assets like your 401k, 403b, and your pension, and the amount of Social Security that counts toward income. And then let's say you had tax-free assets like Roth IRAs, Roth 401ks, life insurance, municipal bonds, not as much, but we'll just say that for now. Municipal bonds, all of these things would be tax-free. Now, what's the benefit of having your assets structured that way? Well, it gives you more control. You can control your tax rate by controlling where you pull money from. You see, the IRS allows you to use a standard deduction to reduce the amount of income that is taxable. So if your total income, your total gross income, plus half of your Social Security, if it's less than the standard deduction, then there are no taxes due on that income. So the key is to try to keep the money coming from tax deferred sources under the standard deduction, right? So the standard deduction for a single person is about $12,000. I think for a married person, it's about $25,000. But the point is that having your money in multiple places allows you to control that. So if you don't want to pay taxes, you just make sure you pull a smaller amount from this bucket and a larger amount from this bucket, because everything in this bucket is automatically tax-free. Your Roth IRA, your life insurance, your municipal bonds, to a certain extent, they're already tax-free. So that same scenario, $90,000, you can actually maneuver matters so that you don't pay taxes at all. So as stated earlier, organizing your affairs, your assets to pay no taxes in retirement requires a plan, but it doesn't have to be hard. In fact, we're helping clients on a weekly basis to create tax advantage sources of income so that they can control their tax rate in retirement. Obviously, if you need our help, all you have to do is go into the description, click on the calendar link, and we will be happy to meet with you. In that meeting, we'll talk through what you're trying to accomplish and offer potential solutions that'll help you create more tax-free retirement income. And if you found this video valuable, give us a like, subscribe to the channel, let us know in the comments. We'd appreciate that. And let us know how you're going about strategically trying to create tax-free income for yourself. We'd love to discuss that in the comment section as well. Until next time we talk, until the next time we speak, take care.